Good morning, guys. Happy Monday. It's been a while and not too much has gone on. It is summertime, and for capital markets world, it's sell in May and go away. But it's sort of like you could hear a pin drop when you think a little bit about the economy, how things could change, especially for US residents and citizens almost day to day, right? Like we get the news about the Biden administration canceling debt, and then it gets bogged down in Congress, and it doesn't happen, and it's insane to see, the sort of monetary and fiscal policy stuff really dig into direct like American lives and economies. I mean, especially since COVID, it has been unbelievably direct. Stimulus checks, debt cancellations, PPP loans. This was something I was talking about yesterday with a couple of people, particularly how PPP loans are now such a source of sort of like accusations of fraud and policing and banks investigating their own clients. And then we go to stimulus payments and sort of like how direct that was for the government to have done. The US government has done that kind of stuff before, but it was certainly sort of unique for modern times. And that brings me a little bit to last week's wrap up of where we stand as far as kind of those broad economic themes and market themes that can affect our daily lives. And last week we talked about it. Inflation came in unbelievably cool. Year over year, we're looking at 3% inflation for this month, which is still inflation, right? It's still price increases. It's not flat, it's not negative, but it's a massive slowdown versus the year before. And why is that important? Well, it's important because we live our lives on these terms. We buy food, we pay rent, we pay for utilities. And so it's important to note when those costs are changing ahead of especially corporate earnings or ahead of kind of the actual impact on the broader economy. Those numbers tend to be a little bit lead lag in respect to that. But more importantly, it has direct impact on the fiscal and monetary policies that come out and touch us individuals that, from the very, very high levels of government. And in this case, with inflation cooling, everyone's looking at the Federal Reserve and asking, are you going to lower interest rates? Are you going to make home loans cheaper? Are you going to bring those things down that you said you brought up to fight inflation because inflation's going away? Now, if we look at kind of the trading in the market, right, because price reflects truth, we see that the market expects rates to continue to go up, especially through the next meeting. But now we're having conversations about interest rates maybe even being like negative, not negative, but cutting them as early as next March. So now that speculation is driving in. Why do I start with this big, bad, boring stuff? Because it ends up impacting your life directly and impacting your portfolio, especially now that we're coming into a week with corporate earnings. You may see in our agenda corporate earnings. It's the last item we have for today, but I'm going to start with it because what has gone on this year? We have seen US stocks do unbelievably well. We've seen technology stocks do unbelievably well, and these are typically stocks that do well in this manner, meaning returns greater than 10%, when interest rates are cut, when money is cheap, when it makes sense to invest cheap cash into tech where you can scale things very quickly, and then when you turn on the monetization feature, you monetize at scale. And that's also the boon of the bane of these businesses as well, is that when money is expensive, it's not worth it for a lot of investors, who are looking at these tech companies, to give them money at an expensive rate that they burn on acquiring users that haven't been proven to be monetized just yet. They're just operating off of the principles and sort of magnitudes that are possible in technology and the margins that are possible in technology once you build the thing. So coming up to these corporate earnings, what's up? We have inflation cooling really hard. We have the market starting to speculate that rates are going to come down. That's very good for tech, for US tech. Corporate earnings need to come in strong this season, because if corporate earnings come in soft, it tells everyone, oh my gosh, maybe there's a recession. And maybe that's why inflation's coming down, because recession, and mentally a lot of investors will go on defense. A lot of individuals will go on defense and hoard cash and that type of thing. But especially if you're young, it's a really interesting moment to get into building your portfolio and thinking about asset allocation because there's some volatility. There's a lot of interest rate speculation. Interest rates are like commanding the market. There are very, I like to think of kind of investing from the top down view, factor investing, where I analyze the entire universe and I try to find the hot spots of certain factors. The most important factor is interest rates. And that's why I spend so much time talking about it. But enough about that. Point is, earnings are coming in this week. We'll see how they are. If they reflect weakness, it sort of means the Fed won, and they, killed inflation by kind of creating a little bit of a synthetic recession. But it could cause some investor panic. So more volatility. If earnings are strong, it kind of shows a little bit of that miracle that people have been talking about in the investing world of a soft landing, of whether the Fed could squash inflation without putting us into a recession, which is really like threading the needle, like really hitting the bullseye, low probability positive outcome. But it'll certainly inspire markets, and we could see some upside there. So corporate earnings this time around, they're important. Long-term investing wise, they're not terribly important when you're making a very long-term decision. You look at several earnings quarters, you look at longer-term trends. So it's not something worth getting bogged down on. A lot of people like to bet on earnings reports, buy some call options the day before that expire the day of earnings, and it's just some highly speculative stuff. Kind of a fool's errand, can be fun, if you have a really strong view or you think you know something that most people don't. Within reason, of course. So don't recommend that whatsoever. But always learn something new when you listen to an earnings call or read an earnings transcript. More signs that it's the 70s again. That's my second topic here. And this is really just for fun. I mean, I think I've written a piece up on Substack about this, but we have seen like a very funny like late 70s atmosphere, I'd say, over the last 2 years, kind of post-COVID lockdown, that sort of thing. Rates going up. In the 80s, we had Volcker, who was the Fed chair, and he raised interest rates like 20% to fight inflation, and he fought inflation successfully, but it kind of rattled everyone, including the economy. There was oil embargo, disco culture, bank robberies, political strife, that sort of thing. And so I've kept saying for the last 2 years almost that we're in the 70s redux. And I was just laughing this morning reading Bloomberg, showing that there's a jewelry heist that still is unresolved, and the value of the heist is somewhere between a couple million and 100 million. And it just kind of gave me the giggles. And I read it next to an article of, oil prices are surging after OPEC cut supply and demand is raising. So we're seeing a little bit of a price rally in oil, and at that time there was a lot of volatility in oil prices and that sort of thing. So 70s redux. And then the starter, the opener that I skipped over today was China's economic slowdown. And this is something that we've been covering, we've been commenting on since last year, following sort of the breakdown of their real estate market, the troubles they've had in the financial markets as well, with loans going bad. The Chinese government shut down Ant Financial, Jack Ma of Alibaba, his financial services company in China. There's just been a kind of a purge both in tech, finance, and real estate in China, and I think that combined with COVID, combined with maybe other markets that they sell to slowing down a little bit, trying to fight inflation, have driven China into a tough position. And so the consensus is in the investing world is starting to become that China is a little bit on a rickety bridge, not as attractive. A lot of firms are cutting China to underweight. Interestingly enough, there are quite a bit like macro firms and large banks, asset managers that are still overweight China. But something that I want to bring to attention is, I think it's called second order risk or second order effects. And this is the case, this is what we see in China. I mean, China is a communist country. It is, Maoist socialism. And the power is very centralized in a very sort of top-down way, high degree of control. And just this morning, there have been conversations about, I'm trying to remember, well, Russia nationalizing foreign assets in Russia. And that's something that happens in countries that have either an authoritarian, a dictatorship, or a communist regime that's highly centralized. One can toy with the idea of doing business there, even if they open certain areas or markets where you can do business there. It can be very lucrative, it can be very controlled, very well regulated, but ultimately you run the risk that the powers that be decide night to day to just completely shut you down, and there's virtually no recourse through international courts or arbitrations. They kind of just have final say and an unbelievable reach when it comes to their power and ability to execute and just straight up expropriate your assets. And so, a lot of global investors are kind of touting that right now, saying, I don't invest in countries that have these second order effects or have governments that can just shut me down night to day, and there's no like legal recourse within the country or without, from without the country. So the China economic slowdown is something to be watched carefully. Of course, I think if the U.S. is able to dodge a recession, continue on a growth pattern, especially the growth trajectory it's had this year, that could help actually buoy the Chinese economic slowdown, because we're a huge buyer. And I've talked about it before, companies like Apple leaving China to manufacture in India and in other parts of the world. Many companies following suit with that strategy of diffusing their operations away from China and diversifying out, training other regions of the world for workforce. I think it's brilliant, sort of diversify your jurisdictional risk. Fantastic, but we'll see the ebb and flow of those two things. Because if China can kind of get its house in order and regain international confidence in investing in its market in the near term, and also kind of quell some of the international tensions with Japan, with the U.S., I think that they could dodge a bullet here. But I've said this before too. I remember, almost 15 years ago now, in school, I'm not giving myself enough credit, maybe like 12 years, in undergrad, I was doing a project. I went to the Chinese embassy, and they couldn't emphasize more how much China needed an 8.5% growth rate, and this was several years ago. Now they're growing at a much lower rate than that. I think around 5%. And they said, if we don't achieve this growth rate, there actually is kind of like a measurable kind of harmful effect on people who have been like participating in the growth or were beneficiaries at the top, and people who are looking for opportunities to do different things or urbanize, etc., in their country. So I think we hit all the agenda. We'll catch up on Wednesday this week as well. I think I'm going to do it on Wednesday afternoon. I'll write it in the Discord, but we're going to do a portfolio review. We're going to check up on the model portfolio, walk through some of the methodology, some of the theses behind some of the picks, and decide if we're going to make any changes. We have not made any changes since January. We're very happy with the performance of the model portfolio. It's beat our benchmark, the S&P, by a margin of about 11% last time I checked at the beginning of the month. So it should be fun. And we'll also try to do a couple more sessions where we just spitball some ideas, maybe some shorter term stuff, despite that not being the core focus of what we do here. We do long term, pretty much long only, buy as a buyer for life type investment style, from the top down, a little bit of factor, a little bit of stock picking. It's good stuff. Anyways, guys, we'll catch up later. Take care. See you on Wednesday.